you so much for joining today. On behalf of Wealthstream Advisors and Patterson Belknap, who are together presenting this webinar on cross-border planning issues, we're so happy to have you with us. I'm excited to introduce Jenny Longman and Irene Kim of Patterson's Tax Department, where they advise clients on domestic and international tax issues and international estate planning. They have a wealth of knowledge, and we're so excited to share that with you today. The genesis of this webinar was actually a conversation that Jenny and I had a while back about just how common it is in our financial planning work at Wealthstream and also in Jenny's legal practice at Patterson for us to see well-meaning taxpayers find themselves on the wrong side of a tax rule because they just don't know the important things about cross-border financial planning and tax planning. So essentially the goals today are going to be to help our audience better spot tax pitfalls, to do more proactive cross-border planning, and to remedy mistakes if they happen. So the topics that we'll cover today will include reporting based on ownership of foreign assets, whether or not you receive income, reporting and planning in connection with gifts and inheritances, and also expatriation considerations. And it's important to note that what we'll be focusing on today are U.S. tax compliance and planning issues affecting U.S. taxpayers with income or assets outside of the U.S. If anyone has questions about the intersection of U.S. law with a specific foreign country, or if you'd like to go deeper on any of these topics, we would be happy to follow up with you afterwards if you want to send us an email. We have some important disclosures to note. Wealthstream Advisors is a registered investment advisor with its principal place of business in the state of New York. This webinar contains general information that's not suitable for everyone. The information contained herein should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this webinar will come to pass. Information presented herein is subject to change without notice and should not be considered as a solicitation to buy or sell securities. And the information presented at Patterson Belknap programs is for general information purposes only and should not be construed as specific legal advice. It is for personal, non-commercial use and may not be reproduced, copied, or disseminated in whole or in part. So with that out of the way, we can move on to our first topic. The first topic we'll discuss is ownership of foreign assets, beginning with reporting based on ownership of foreign assets. So Irene, what rules would you highlight for our audience here?
Yeah, so this category really covers two different compliance regimes. The first set of rules are the information reporting rules, and those specifically that govern the disclosure of foreign assets. The policy purpose of the information reporting rules is not so much about reporting income for the purpose of calculating your tax liability, but it's really about, designed to solicit information about your foreign assets that would enable the IRS to do its job of essentially curbing tax evasion. So the purpose is to provide the IRS with enough information to decide whether or not to spend their resources to audit you. Information such as the fact that you own foreign assets, their value, perhaps transactions that you engage in with these assets, which include interest in foreign entities.
Go ahead, Irene.
Typically, significant penalties apply to these, the non-filing or failure to adequately disclose information on these forms, because really the purpose of these forms is to provide sufficient information to the IRS. And the categories of foreign assets subject to information reporting include foreign bank accounts and investment accounts, stock of a foreign corporation, interest in a foreign partnership, and transactions with an interest in a foreign trust. And we also wanted to flag that if you acquire or own real estate through an entity, that may also trigger reporting requirements depending on how it's held.
And this is something that I think is one of the things that's easy to overlook in some ways, because if a taxpayer is just in the habit of simply collecting 1099s and K1s and delivering them to their accountant, they will miss this because foreign accounts, of course, do not issue US tax forms. So the onus is really on the taxpayer to report those assets.
Yeah, I would also jump in to note that the penalty structure on these foreign information returns does not correlate with whether income was actually generated by the asset. So a lot of our clients are very surprised to learn they could have significant penalty exposure even when they didn't actually earn any income from the asset that's supposed to be reported.
Great. And the second area, the second set of rules that we've included in this first category are the anti-deferral rules. And unlike information reporting, these are income tax reporting rules. But what is tricky about these regimes is that you may have to actually report and be taxed on income that you haven't economically received yet, and you may not have a legal right to access. The rules include those governing controlled foreign corporation, or CFCs for short, the PFIC rules, which stands for passive foreign investment companies. And there's a third set of rules, which we won't discuss today in the interest of time, and those govern foreign non-grantor trusts. So you may be hearing for the first time today that you can be taxed on income that you haven't economically received. And if so, it may be helpful to provide a little bit of context. So the policy behind these anti-deferral rules is about reducing or eliminating the benefit to a U.S. person of keeping income parked offshore in a foreign entity, as opposed to repatriating that money currently to the U.S. in the form of a distribution to the U.S. owner. So there are other areas of U.S. international tax law that may take more of a carrot rather than a stick approach to encouraging repatriation. These are not, these are not those. These are definitely the sticks. So it would take much more time to go through all the technical rules governing CFCs and PFICs. They are incredibly complex, but we just want to provide an overview so you are generally aware that these reporting regimes exist.
And in our work, where we would come across PFICs are in the form of foreign mutual funds, ETFs, holding companies, investment trusts. And again, there's a low degree of awareness that these types of foreign investments can trigger sort of adverse tax consequences.
Yeah, and I would also jump in to say that in the context of PFIC, since Brenna brought it up, some of our clients are familiar with the concept of a PFIC, and Irene will go into this in more detail. But a foreign, an Irish fund or something is a good example of a PFIC. It's a publicly traded interest in some kind of company, an investment company. But there are kind of sneakier PFICs out there that can take taxpayers by surprise. So an interest in a family company that someone thinks of as an operating company, and yet under our rules, it might actually be determined to be passive. So there can be some rude surprises there. And all the more reason to give your tax advisors a lot of information about the non-US assets that you might own interests in.
Absolutely.
So that's a great segue. Let's run through some of the technical rules, just because it's not always intuitive whether you have a CFC or a PFIC involved. So a controlled foreign corporation is defined as a foreign corporation that is more than 50% owned by vote or value by one or more 10% or greater U.S. shareholder. And it could be one or several U.S. shareholders that trigger this status, but it's really only the holdings of these substantial 10% or greater owners that count towards the control requirement. For example, if a foreign corporation has 5 shareholders, 4 of which own, let's say, 10% of common, one that owns 11%, that foreign corporation would qualify as a CFC. If instead a single U.S. shareholder were to own 51% of common, so vote and value, that would also trigger CFC status. But for a foreign corporation that's publicly traded and happens to have more than 50% ownership by U.S. persons, each of whom or which own a very small percentage, then that is not a CFC, even though it's majority owned by U.S. persons. So let's say you discover that you, as a US person, own stock of a CFC. It's only if you're one of those 10% or greater US shareholders that you would be required to include in your income a proportionate share of the CFC's income for the entity's taxable year that ends within or with your reporting period, the calendar year. And you would report that income on Form 5471, which you would file with your personal US income tax return. And I won't go into details, but the calculation of that inclusion amount is incredibly complex, and it invokes rules that you may have heard of in passing, GILTI and Subpart F. As I mentioned before, there are significant penalties for many of these forms, and that also includes the 5471. And just to give you a sense, the penalty associated with a failure to file the 5471 is $10,000 per CFC per tax year, and that can be increased by up to an additional $50,000 following the IRS's 90-day notice. So you can imagine if you're dealing with a multinational group with many foreign subs, and it's only after years of non-compliance that this issue comes up, the penalties can really start to add up quickly. So why is this an area that tends to be a pitfall? Well-meaning taxpayers may find themselves in situations where they've gone for years not realizing that they have a filing obligation. One reason for that may be because it is not so straightforward to determine whether a foreign corporation is a CFC, and in turn, whether a US person is a 10% or greater US shareholder. The definition of ownership includes not only direct and indirect ownership, but also requires the application of these constructive attribution rules that are attributed between related parties, sometimes from entity to owner or owner to entity, and can stack, one on top of another. So sometimes it's not obvious looking at an org chart whether a given foreign corporation is a CFC, because what may be obvious is just the direct or indirect ownership. So the second anti-deferral regime applies to US owners of PFIC stock. So PFIC is it stands for Passive Foreign Investment Company, and it's a foreign corporation that meets either an income test or an asset test for meeting a threshold level of relative passive income or assets. So under the income test, a non-US corporation would qualify as a PFIC if at least 75% or more of its gross income is passive. So passive income includes interest, dividends, rental income, royalties, and capital gains from the disposition of securities. Under the asset test, a foreign corporation qualifies as a PFIC if at least 50% of the company's assets are investments that produce passive income. And what's more, once a foreign corporation is a PFIC with respect to you as a US holder, it retains that status even if it no longer meets either the income or asset test in a later year. We call this, or we refer to this as once a PFIC, always a PFIC. This principle. So the consequences under the PFIC regime. The PFIC rules apply to US shareholders at any level of ownership, which is different from the CFC regime. So under these rules, US owners are generally subject to adverse tax treatment on distributions and gains from the sale or other disposition of PFIC stock, including gifts. So first, distributions out of PFICs are not eligible for qualified dividend treatment. So dividends are taxed as ordinary income and not eligible for the lower long-term capital gain rate. Second, and the main reason why PFICs are thought of as not an ideal investment for US taxpayers is because US taxpayers are effectively penalized for making overseas investments under the excess distribution regime. So an excess distribution, and I know I'm getting very technical, but an excess distribution is the portion of a distribution in a given year that exceeds a certain threshold. So exceeds 125% of average distributions over a 3-year look back period. So let's say you are a US person who has held PFIC stock for 4 years. You receive a current distribution in the current year, year 4. There have been no distributions in years 1 through 3. Whatever that amount is, that would be an excess distribution because it's over the $0 average over the last 3 years. So if a PFIC makes an excess distribution to you, the amount of the distribution that is considered excess is allocated. It's apportioned across your holding period over the however many years. And the amount that you receive that's allocated to the current year is ordinary income. And over the look back period, any amount that's apportioned to prior years during which you held PFIC stock is taxed at the highest marginal rate for ordinary income effective that year. And also there is an interest charge applied to that tax, whatever that tax amount is, as if you should have been paying tax, but were delinquent and didn't. So that interest would accrue up to the current year.
So Irene, just to underline that, so the income that you may have received from that PFIC would be taxed at the highest ordinary income rate, regardless of what your personal income tax rate is. Is that right?
Yeah, that's right. For those prior years.
Got it.
And you may be thinking, hey, let's just sell the stock in year 4 prior to receiving this distribution and we'll get away scot-free. The rules say that any gain on the sale of PFIC stock or other disposition is also treated as an excess distribution. So that would not be a way out. Reporting related to PFICs is done on Form 8621, and that's a multi-purpose form where you would report distributions, gains, and also information relating to one of 2 PFIC elections that are available. There's another, but we won't get into it. The QEF election or the mark-to-market election. And those elections help mitigate the default adverse tax treatment, but it requires that you comply with annual reporting. And the QEF election is typically only available if it requires cooperation from the corporation. They would have to give you some information to then remit to the IRS. So it's not always available.
So Irene, just to underscore that then too, so if you wanted to avoid or somewhat manage the adverse tax treatment of the PFICs, your options are essentially to, I guess, search for a foreign investment that has made that QEF, that qualifying electing fund election. Mm-hmm. So it would avoid some of that PFIC treatment, or to, as an individual, make a mark-to-market election.
If that's available, and we'll go into that, but that would require that the stock be publicly traded. So if you're talking about, foreign mutual funds, we expect that to be available. If you're talking about a family corporation, probably not.
Got it. Terrific. Okay. Shall we go on to our example?
Yeah, actually, that is fine. I was just going to identify a few different examples of PFICs, but I think Jenny already covered that.
Here we go. So to illustrate the foreign asset reporting concepts and how they would apply in practice, we can consider the example of a hypothetical client we'll call Ingrid. So Ingrid is a U.S. green card holder who's been living in the U.S. for 8 years and a few months ago inherited several types of property that were owned by her mother. So facts about Ingrid: has been in the U.S. for 8 years, U.S. green card holder. Her mother is German and recently passed. She has 2 non-U.S. siblings. The recent inheritance included an interest in a German GmbH, which is a bit like a limited liability company that owns rental real estate in Berlin, a portfolio of liquid securities consisting primarily of investment funds marketed to non-U.S. persons, and a 1/3 share in her family's historic business organized as an AG or a stock company. So Irene, what are some of the considerations here?
Yeah, so this is probably a pretty typical scenario where a U.S. individual would first encounter the reporting rules when they first inherit property from a non-U.S. family member. And the first thing I notice is that Ingrid is a U.S. green card holder. So we know she is a tax resident for U.S. income tax purposes. And in addition to being subject to worldwide income, tax on worldwide income, she's subject to the rules we just discussed. So the next step would really be to figure out which categories of foreign assets are in the mix. If we're dealing with interest in a foreign entity, as we are here, we need to really translate what that foreign entity is under local law to the entity's classification for U.S. income tax purposes, whether it's a flow-through or a corporation. And, you know, as you mentioned, for the GmbH, we know that that's equivalent to a domestic LLC, and we'll sort of go into that in a second. But the rules for determining the U.S. classification of foreign entities generally provide a list of entities by country that are definitely corporations, and for the rest that aren't on the list, it generally depends on whether all of the members have limited liability. So in the case of the GmbH, Jenny and I are familiar enough with that entity to know also that it is an equivalent of an LLC, provides limited liability for all of its owners, so we would assume that's a foreign corporation. So that the first asset described is really a 1/3 interest held by a U.S. person in what we now know as a foreign corporation that holds nothing but rental real estate. And since we know that the other two owners are non-U.S., we don't have to worry about the CFC rules because this entity is not more than 50% owned by U.S. persons. So then we'd think about whether this GmbH is a PFIC. And you may recall that I mentioned, you know, I rattled off a long list of passive income. And what I didn't mention is that rental income could be either passive or active depending on the facts. And it really comes down to whether the real estate is actively managed. So here we don't have enough information to know whether it's a PFIC, but the next question would be to ask whether the corporation has employees that actively manages the real estate. And then we could sort of determine whether Ingrid has a filing obligation with respect to that asset. So the next category, the portfolio of liquid securities, the facts mention that it consists primarily of investment funds marketed to non-U.S. persons. So based on these facts, we know that it is highly likely that these investment funds are PFICs. Let's assume they are. And also, you know, we would suggest that Ingrid contact her tax advisor who can help her figure out whether the funds would permit her to make a QEF election. But here, the facts indicate that the funds are marketed to non-U.S. persons. So we think that may be pretty unlikely. And assuming a QEF election is not available, as we mentioned before, there's the mark-to-market election, which Ingrid can make unilaterally. And here it looks like it would be available because the PFIC is publicly traded. And lastly, we have the family business. So the analysis, the German AG is on the list of entities that are definitely considered corporations for U.S. tax purposes. So the analysis is very similar to START. We have a 1/3 interest held by a U.S. person in a foreign corporation that's not more than 50% owned by U.S. people. So it's not a PFIC. And again, we have to run the analysis under the PFIC rules. And here the example suggests that the German AG houses a historic operating business, but we're not given any information about the income or the assets of the corporation. So the only way of determining whether this entity is a PFIC is by taking a closer look at the financials, specifically the income statements and the balance sheets. So the income test, under the income test, we would determine whether, based on the year-end income statement for the year in which Ingrid acquires her interest, whether 75% or more of the income is passive income. And that may be enough to trigger the PFIC status. If not, we would still have to run the asset test and take a look at the balance sheets for all quarters of that year And if 50% or more of the assets based on a quarterly average are passive, then that could also trigger PFIC status under the asset test.
Got it. Okay.
I would just jump in with a couple of other points if we could just go back to that slide for a second. So there could be a lot of surprises with historic family businesses, which I mentioned earlier, and some of those surprises are only able to be confirmed when we have a structure chart to look at, because the PFIC rules are, of course, very complicated, but there are additional complications based on the underlying structure in a business. So I'll leave it at that, but we would always ask for lots of details about not only the nature of the income earned in the business, but also, you know, what underlies the family holding company. Sometimes one strategy will look to employ, which can be implemented on a retroactive basis, is you know, using what we call the check the box rules, the entity classification rules, to our advantage. In our example with the German AG, that wouldn't be available because, as Irene mentioned, a German AG is what we call a per se corporation. It cannot elect its classification. But if the family business were operated through a GmbH, for example, like our real estate company, we might consider whether a check the box election could be helpful. Sometimes it might be a little too late by the time we get the information, and it would have to be like done, you know, we'd have to deal with the US tax consequences in the hands of our client with the election. But sometimes in the context of pre-immigration planning or sort of pre-inheritance planning, there may be some possibilities to kind of change the structure for US tax purposes before it falls into the hands of a US person. Again, that's all kind of complicated, and there's a lot of, you know, additional facts we'd have to check, but these are valuable tools in the toolbox when it comes to foreign assets.
Terrific. So continuing on our example about Ingrid, is there anything she needs to do today upon receiving these assets? Or is it something more to the effect of, does she not have to worry about tax reporting until the assets generate income? I think we know that that is not the case. So what should Ingrid endeavor to do today?
So Ingrid should definitely tell her tax advisors all about these assets. It would be better still if she knew they were coming and had discussed this possibility of, you know, inheriting and when with her tax advisor. So perhaps some preemptive planning could have been done. And, you know, she should certainly consider elections that may or may not be available on the PFIC side. As Irene mentioned, she might want to consider selling some of the assets if they're just not a great fit from a US tax perspective. I mean, I think Brenna could probably speak to this better, but, you know, the exposure to certain companies that, you know, she's receiving through these investments not normally marketed to US people might be able to be replicated into by products that are better suited for US taxpayers. So that's something she could certainly explore with her investment advisor. So those are the kinds of things that we would encourage our clients to speak to their advisors about. Certainly, you know, the theme, I think, in this whole presentation is the sooner the better. But, you know, it's also not unusual that we're informed late in the game. And I think that brings us to our next complication.
Right. Well, so Jenny, just to go back for a moment. So I love your point about if you're aware of some foreign inheritance that may come your way at some point, to sort of raise that with your advisors in advance. What would be some just some thoughts that you'd have if a client came to you and you know, in advance of inheriting, say the same fact pattern, what would be the
I'm gonna defer that to the next area, because I think when we cover gifts, that can apply equally to inheritances. So I think in the interest of time, we will absolutely cover that. But let's finish this one.
Great.
And let's just talk briefly about another common situation we see, which is where a client tells us about what he or she has inherited, like maybe a few years later, because it was only at that later date that the client finally got some income from the asset. So again, going to Irene's point that, you know, it doesn't matter in many cases that the foreign asset did not throw off any income that economically was realized by the client. It's enough that they owned the thing, So this again is very, very common. And I have a situation on my desk today, actually, where there's a UK family has a successful family business. Let's call it a high-end widget business. They have boutiques around the world. And the father, the founder, is looking, to further his succession plan and has been giving his son more and more control over the business and made some gifts that were very carefully vetted by UK advisors. Meanwhile, the US son had moved to the US a few years ago. And unfortunately, although the son was very careful to report his compensation and dividend income received out of the structure, his US tax advisor was only very recently made aware of what the structure actually looks like. So here we are now investigating whether this client has US income tax exposure for the last several years, what kind of foreign information return penalty exposure there might be. Turns out that this is a structure with a whole bunch of CFCs in different tiers, so it's very complicated. And again, like, these were well-meaning taxpayers. They thought they were doing the right thing, but there was an information breakdown.
Yes.
So in these situations, first, we'll try to evaluate, well, what is the exposure, both income tax and information return penalties? And we'll always work with an accounting firm in developing that analysis. And then we try to come up with, a few possible solutions for the client. Frequently, that solution involves using a special IRS compliance program called the Streamlined Filing Compliance Procedures. And that's a program that lets non-willful taxpayers, like anyone we're talking about in this presentation, people are trying to do the right thing, but because of the complexity of the rules or ignorance of the law or whatever reason, just failed to actually get things right. And that program requires filing 3 years of amended returns, 6 years of foreign bank account reports, and submitting a very detailed narrative of the whole story, like why the person didn't comply the first time around. And it also requires payment of a penalty. And that's kind of where the analysis becomes a little stickier, because we have to weigh like the cost of the penalty required by this program, which is 5% of the value of the asset that should have been reported and was not. But in return for paying that penalty, the IRS does not assess foreign information return penalties. So you have to do this balancing act, essentially. It's like, well, what penalty exposure might I have if I don't do this program? And then what does it cost to do this program? And there's no right answer on this stuff, as far as like, well, what's the absolute right path here? People choose different things based on their different scenarios, and it's a complicated analysis. But it is not an uncommon occurrence that the past is not perfect. And then we'll work with both the client and any other advisors, including foreign advisors, to clean it up, because sometimes we find there's tax non-compliance in more than one jurisdiction. So then we need to kind of be careful about consistency.
That's a really great point, though. And that's really good news, is that though these penalties can be very high, there are pathways to correcting past mistakes just by sort of detailing how the mistake was made. So if you weren't actively trying to hide information or sort of avoid income tax, there are great ways to get these things fixed moving forward. Okay, so shall we go on to our client example on gifts and inheritances?
Yeah, so before we get into the details of our example, I'll give a very brief overview of US estate and gift tax regimes and how they apply to both US citizens and residents, as well as how they apply to non-residents. So we have two basic regimes with very different rules. So US citizens and individuals who are considered to be residents for estate and gift tax purposes, which is a different residency definition than for income tax. They have one set of rules, which is transfers of their worldwide assets are subject to gift or estate tax at a rate of 40%. That's the current federal rate. There may also be state level transfer tax that could apply. So a resident for estate and gift tax purposes is a domiciliary, meaning someone who has put down roots in the US and intends to remain, and has no plans to, pick up and move elsewhere. That's a very subjective analysis, and that's to be contrasted with the definition of a resident for income tax purposes. So that's much more black or white. In this presentation, we're dealing mostly with green card holders, which is, its own immigration classification. But an income tax resident also includes individuals who pass a threshold day count test, and that's called the substantial presence test. So it is possible for someone to be an income tax resident and not be an estate and gift tax resident. It's also possible for a green card holder to not be an estate and gift tax resident, because the concept of domicile, although somewhat linked to the concept of being admitted to the US as a lawful permanent resident, is not exactly the same. There is a divergence in the tax law and the immigration law. So another point that can be really confusing to both US and non-US persons alike. In addition to being taxed on worldwide assets upon transfer, US citizens and residents for transfer tax purposes also enjoy what is now a very generous lifetime exemption of about 13.6 million per person. So that means the first 13.6 million of value of wealth that's transferred by a US citizen or domiciliary can be done so without the imposition of US gift or estate tax. That exemption amount is scheduled to decrease beginning in 2026 under current legislation. We don't know what the future will bring as far as whether that there will be new laws enacted or changes in the exemption. But anyway, the default is that it will reset to, I think, 5 million plus an inflation adjustment amount beginning in 2026. So now contrast that with the regime that applies to non-residents, non-citizens. So those individuals are subject to US estate and gift tax on transfers of US situs assets. Examples of US situs assets for both estate and gift tax would include real estate located in the US, tangible personal property located in the US. The situs rules for US stock are actually different depending on whether we're talking about gift or estate tax. So that's a little bit, confusing and certainly not intuitive. So US stock can be gifted by a non-resident free of gift tax. But if that same non-resident alien were to pass away owning the stock in his or her name, then the value would be subject to federal estate tax. Another key point in this area is to recognize that non-residents do not have the very generous lifetime exemption available to them. We do have some estate and gift tax treaties out there that change that a bit, but the general rule is no, all they have is a $60,000 exemption. So I have found in my discussions with foreign clients and foreign advisors that this is a big misconception that kind of everyone in the world has today like $13 million worth of value to play with. Not true. So that's a very key point to walk away with. I think if you're not a US citizen or domiciliary, is that you have to be very careful with your US situs assets. So that's kind of the lay of the land on the transferor level. But when we're talking about a recipient of a gift or an inheritance who's a US person, the general rule is there won't be any tax. There's an exception to that we'll cover at the end, but that's a very unusual circumstance. And although there is no tax, you do have to report it. And there's a special foreign information return form called Form 3520, where you would report either receipt of a gift from a non-resident alien or an inheritance from a foreign estate. That form's also used for all sorts of foreign trust related transactions, but we're not going to get into that. That's a whole other presentation. So failure to file that form timely has resulted in a lot of aggressive automatic penalties from the IRS in recent years. So that's been a big part of our practice, I would say, has been dealing with those awful penalties for our clients. Again, well-meaning clients, often the IRS just processes the form wrong in some cases and hits it with an automatic penalty, but that's a big one. Those penalties are particularly high.
Hmm.
So with that, I think let's go to our example.
Terrific. Okay. So our next example, bear with me, there we go, has to do with Mark. So Mark is a US citizen whose grandmother Caroline lives in Switzerland. Caroline would like to make a gift to Mark and her other grandchildren, none of whom live in the US, and has a few assets in mind. So Mark would be receiving some of these assets, and the assets he may receive include real estate in Switzerland, a portfolio of highly appreciated US equities held in Caroline's name, shares in a family company, or cash.
Okay, so this is the example I alluded to earlier when I told Brenna I would deal with the questions about anticipating an inheritance, because it's a very similar concept. So here, we're talking about a gift. This could apply almost equally well to grandma saying, hey, you know, is there any planning I should do before I pass away, as opposed to making a current gift? So when we're thinking about this kind of planning, transfer of wealth from non-US family to a US person for tax purposes, there's a couple of different concepts we're thinking about. One has to do with the nature of the asset itself to be transferred, the nature of the property. And the second is the form of transfer, whether it's a transfer directly to that US individual or a transfer in some structure, which most frequently would be a trust. So first, we'll go through the different assets. So real estate in Switzerland. Real estate is always a tricky kind of an asset. It's special. So there are certainly non-tax considerations here that we won't really spend time on, but they're practical kinds of issues. Like, hey, does Mark have any appetite for owning real estate in Switzerland? Is it rental real estate? Is there someone on the ground in Switzerland who can manage that? So those kinds of issues should certainly be part of the discussion. Another repeat issue we see with real estate kind of also incorporates the form of the transfer, but what is very typical, certainly in civil law countries, is the donor, so grandma, Caroline here, often would seek to retain a life interest or an income interest for herself in that real estate. And then what she would be giving to Mark is what we call a bare ownership interest or bare legal title to the real estate. The reason this is popular is because it allows for a very efficient method of taxation in the foreign jurisdiction. So it reduces the gift tax that Caroline would need to pay under her local laws. And it also means that when Caroline later passes away, the value of that real estate is no longer in her estate. So I think in Switzerland, I don't know the specific rules on real estate. France, we see this all the time. And it's a huge, huge tax saver in France, and it's absolutely ubiquitous in France. But the issues with this kind of property division is that there's not a lot of helpful authority in the US as far as the tax consequences of this kind of property division. And I think the biggest issue that arises is the question of whether Mark here would be eligible for a stepped up basis in the real estate if what has happened is he's received a bare ownership interest and that later sort of matures into a full interest in the real estate. That's an unsettled area of the law. So we try to avoid that if we can and sort of dissuade the foreign family member from using a structure like that. Another issue that comes up with real estate is that in the home country, often there's some kind of preferential tax regime that applies when real estate's been held in a family for a long period of time. So it might be the case that, if Mark lived in Switzerland and sold the real estate, years later, he may not be taxed on the gain in the real estate. I don't know that this is true in Switzerland. I'm not a Swiss tax advisor, obviously, but we've seen this concept in other countries. And unfortunately, the US wouldn't care that the gain is not taxed in the home country. It would be reported here in the US. You'd have to pay whatever US taxes otherwise due. And if there's no foreign tax paid, well, who cares? It just means you don't get a foreign tax credit. So if Caroline, grandma, instead made a gift or left this real estate in her by will to a different family member who maybe lives in Switzerland or elsewhere in Europe, who knows, some jurisdiction that wouldn't tax it, then that Swiss tax incentive or that special, tax rule might actually help the family because there would be no tax leakage. So that's an issue we find in real estate that we would always bring up with foreign counsel to understand whether this is particularly inefficient for the U.S. person to own it. Sometimes there's an attachment to the real estate. That's, obviously non-tax considerations are important. But if all else is equal and the family can get by with not paying tax on the gains on this real estate, if it's gifted to someone else, then hey, let's go with that. So now turning to U.S. equities. Here, I chose U.S. equities because it's like an interesting U.S. situs asset because it's U.S. situs classification changes based on whether we're talking about gift or estate taxes. So here we have a few options. Grandma could make a gift of U.S. equities to Mark without incurring U.S. gift tax. However, Mark would then take those U.S. equities with a carryover basis, and assuming that Caroline has held them a long time, there'd be a lot of capital gains tax for Mark to pay when he eventually sells those equities. It is a fine asset for a U.S. taxpayer to own, of course. Like, we're not talking PFIC here. We're talking U.S. stocks. Capital gains rates are preferential rates still. Again, who knows what the future will bring, but right now that's a fine asset to own. But it's not necessarily such an efficient plan from an income tax perspective because we know there's a lot of appreciation there. Caroline, as a foreign individual, can sell those U.S. equities without U.S. capital gains tax. She may not, in Switzerland, my understanding is that there is no capital gains tax upon the sale of stocks. Again, I would, of course, verify that with a Swiss tax advisor, but that's part of the reason we chose Switzerland here, because that's an example I often hear over there. So assuming Switzerland would not levy a tax, or at least at the federal level, and the US won't levy a tax, maybe better for Grandma to sell the stock and then just make a gift of cash to Mark. Shares at a family company, complicated. And this really just goes back to Irene's presentation. We'd have to do the same analysis we would do anytime whether we're faced with a family company. What is this from a U.S. tax perspective? Does it make sense for a U.S. person to own it? Can we do a check the box election? Can we change this thing from a corporation to maybe a partnership from a U.S. tax perspective? And would that, invite other complication? Is that feasible? So that's always a very complicated analysis. But it's necessary. It's just part of the thinking. So that's kind of a flavor of the sorts of issues we would think through for each category of assets that we have in this example. And then the other big consideration is how to make this gift. And that is largely dependent on a couple of factors. One, the value. If we're talking about a gift of $500,000 of cash, just give it directly to Mark. That seems to be a kind of a no-brainer, although again, there's no right answer. We would always consider other possibilities. If we're talking 50 million of value, chances are we will say, whoa, don't make a straight gift of $50 million because all of that falls in Mark's lap as a US person. And we'd rather not have that subject to US estate tax if we can help it. So the structuring strategy here would be for Caroline to make a gift of whatever that value is into a trust for the benefit of Mark and his descendants. The structuring of that trust is complicated, but the takeaway is that trust can be a very, very efficient tax tool, both from an income tax perspective as well as from an estate and gift tax perspective. So they should be strongly considered when non-US family members are looking to make substantial gifts to their heirs who are living in the United States. There may be foreign law reasons why a trust is unworkable. If Caroline instead were living in France, then that might be the end of the trust discussion, but it's absolutely something that we would discuss with foreign advisors.
Perfect. And just in the interest of time, I think we can move on to the last client example that we have, which is about expatriation. So as we've discussed, the US taxes US citizens and green card holders on their worldwide income. And that also comes along with not just income tax, implications, but also these reporting requirements that carry very steep penalties. So Irene, if a US person decides to make a permanent move to another country and likes the idea of just being free of the US tax net, what should they consider?
Yeah, so there are two major US tax consequences to consider for anyone who is considering expatriating from the US and getting out of the US worldwide income tax net. The primary one is the mark-to-market exit tax. And then there's also what's I'll refer to or is referred to as the inheritance tax. So these taxes would only apply to an individual who qualifies as a covered expatriate, not to just anyone who decides to move, and give up whatever their status is. And the primary objective in pre-expatriation planning would be to avoid becoming a covered expatriate to the extent possible. Mm-hmm. So the definition of covered expatriate includes two prongs. The first is the definition of expatriate. So you are an expatriate for US tax purposes if you are a citizen who surrenders your citizenship, or if you are a legal permanent resident in 8 of the last 15 years, so you have this long-term resident status, and then you cease to be a permanent resident by claiming treaty benefits. Mm-hmm. So if you qualify as an expatriate, you would be considered covered. So a covered expatriate if you meet one of 3 tests. The first is a net worth test. So if you have a net worth of more than $2 million on the date of expatriation or termination of residency, or if you have an average net income tax for the past 5 years that exceeds a published threshold. And I believe it's somewhere around just shy of 200,000. And if you the last way to meet the status of being covered is if you've been non-compliant or if you've been unable to prove your tax compliance for the past 5 years before expatriation. So the principal cost, as I mentioned, of being a covered expatriate is the mark-to-market exit tax. Mm-hmm. And that exit tax is generally applied assuming a hypothetical sale of all of your property for fair market value the day before you expatriate. So effectively, the day before you no longer would become subject to worldwide income tax, the U.S., as a U.S. tax resident, so based on that status, you would have to be taxed on the appreciation, kind of built-in gain in all of your assets. So this exit tax makes sure that any of that appreciation that wasn't already subject to the U.S. tax net is taxed on your way out. There are certain, a narrow set of exceptions relating to items like deferred comp or tax deferred accounts, which are excluded from this overall tax regime and can be taxed later under more of a wait and see approach, but it's really the exception rather than the rule. And we also have the inheritance tax, which applies in addition to the exit tax. So if you are a covered expatriate and at any point after expatriation, you make a gift or a bequest to a U.S. citizen or a resident, that recipient is subject to an inheritance tax, and that would be at the highest applicable gift and estate tax rate, which is currently, I believe, 40%. And unlike the exit tax, the inheritance tax is imposed on 40% of the overall value of the gift or request, not just 40% of any additional appreciation after, the exit tax, beyond the exit tax. And it's payable by the recipient, not the covered expatriate. And the last point I'll make is that the inheritance tax applies to any of the covered expatriate's assets that's transferred to the U.S. person in the manner I described, regardless of whether the asset was acquired prior to expatriation or afterwards, and whether or not it's a U.S. situs asset.
So that feeds in well to our example. And we have a couple more minutes left. We'll go through this example. If anyone can stay on for questions, we do have a couple of questions that have been submitted in the chat, but we'll go through this first. So Maurizio is a legal permanent resident and has been living in the US for the last 20 years. He founded his own company and sold it recently at a huge gain. He's been advised to move back to Italy because the inheritance tax rate is much lower. So, Irene, what do we have to think about here?
Maybe I'll kick it to Jenny.
Yeah, so here we've got, so a couple of things that we can pick out from this example. So Maurizio's got a green card. So he's been here for 20 years. Let's also assume, you know, he's had the green card for the requisite 8 out of the last 15 years. That's an underlying assumption. So he's captured by these rules, which is unfortunate. He's thinking, like, kind of, he's halfway there in his thinking, probably. You know, he recently sold his company at a huge gain. So he might think, well, hey, I paid my tax here. This exit tax won't really affect me in a meaningful way. And, you know, the inheritance tax rate in Italy is, you know, teeny compared to what it is in the US. So why don't I just get out? Let me go back to Italy. This is based on a real life example, I will say loosely. So here, what the real problem is, the way I see it, is that he has 3 US citizen children. So he's going to really be stuck by this inheritance tax part of these expatriation rules. And this, in my experience, is the part where clients are very, very rudely surprised, because when they hear about the exit tax, they really only hear about the income tax, the mark-to-market tax. There supposedly are additional rules and regulations coming out on how to actually apply this inheritance tax piece, as well as the exit tax rules. We don't have regulations yet on this body of law. So we may get some more questions answered relatively soon on how exactly these rules apply as far as payment of the tax and everything. But suffice it to say that someone who's considering expatriation who has US heirs should think very carefully before expatriating. And when it comes to a green card holder, the method of expatriation is either like formally abandoning the green card. There's an immigration procedure to do that. Or, as Irene mentioned, a sneakier way, which can lead to unexpected expatriation, which is taking a treaty tiebreaker position once they go back to the other country. So he could still have a green card that potentially could be valid from an immigration perspective. But once he takes that position on his US tax return, that he should be treated as a resident of Italy and not the US under the US-Italy tax treaty, he effectively has expatriated himself. So that's definitely a trap for the unwary, but then it would, you know, trigger all of these rules. So, you know, again, the takeaway there is think very carefully about expatriation. Make sure you get good advice, because that could be a rude surprise.
Absolutely. Okay, well, thank you all so much for joining us. I know we're just at 1 o'clock now, so for anyone who has to jump off, we so appreciate you being here. You know, at Wealthstream, we love to do in-depth planning for our clients to try to identify some of these, you know, opportunities or risks. And we do the best job of that when we are partnered with strong tax advisors like Jenny and Irene. So I'm so glad to introduce them to you, and for all of you to have heard all that great information that they shared. We'll go ahead and look at some of the questions that have come in. So one question was, can you comment on inheritances of PFICs and how much of that you are seeing compared to real estate versus public company stock?
I would say it's all over the board. We see anything and everything. I had a very complicated fact pattern a few years ago of a really, really thorny tiered PFIC family business situation. It was really kind of a combination of non-publicly traded and publicly traded PFIC stock. But yeah, there's no trend, I would say, in the nature of the assets that our clients have. It's all over the place.
Okay, great. And as you were talking about before, Jenny, about sort of investments in U.S. securities that are abroad or here, you know, our outlook is that U.S. generally as an investment universe offers better options in terms of efficiency of trading, low costs, and diversification. You know, if someone has cross-border exposure, we're more likely to recommend something like ETF investments or individual stocks or bonds, which direct indexing can be a great option. So that's something that we talk a lot about with clients who have sort of that cross-border exposure. Going back to the questions, so we have a question that came in just before we started. What is the fiscal status of a European citizen who marries an American citizen and lives in the US? And when should the European citizen get hold of the IRS to register as a US taxpayer?
So this question really brings up the very important question of when does someone's US tax residency begin? So in a situation like this, sometimes the European citizen might acquire a green card as a result of having US citizen spouse. Green card holders are subject to one set of rules under the residency start date system. And basically their US tax residency begins when they are present in the US on a green card. So it's just sort of like all or nothing. Once they're here with the green card, it starts. Frequently, though, there's a period before which the green card is acquired, but they might be living here in the US. And in that case, they would need to be thinking about the other set of rules for tax residency, which is called the substantial presence test. That is a day count test. And under those rules, you have to look to see how many days of presence you have in the United States in the relevant tax year that you're concerned about. And then you also look to see what your days of presence were in the prior 2 years. There's a weighted average formula, and you do the math. And if you reach 183 days in the year you're testing for, based on this formula, then you're a tax resident for that year. But as far as the residency start date goes, like once you're here for a threshold number of days, you're kind of here, but there's some maneuverability there. What often happens is that when people first arrive in the US, like closer to the end of the year, they may be here for some period of time before they're actually US tax residents. So that can actually present an interesting pre-immigration planning opportunity, even while they're kind of here already. It's a little bit of like neither here nor there. But you would need very specific information about day counts and stuff in order to do that analysis.
But this is again another example where thinking ahead and communicating with your tax advisor and financial professionals can offer opportunities for planning that can make things easier.
Absolutely, absolutely. Because during that kind of middle ground period where you're not fully in, that can be an opportune time to kind of clear out some hot potato assets, as we might call them, without having dire US tax consequences, and perhaps making your eventual tax reporting far simpler by, maybe selling some assets that would have meant for very complicated information reporting.
And that's what we see with our clients too, is that the best opportunities are probably in sort of the pre-relocation planning. So before it has been made, to sort of do an assessment of what are the areas that need to be addressed and what are the costs to, change things, potentially sell some investments that would not be ideal to hold after the move and so on.
Exactly.
Right. I think that's all the questions that we've got for now. We'll just give it one more minute to see if anything else comes in. Thank you all again for joining us.
All right, and thank you to Wealthstream for putting this together and facilitating.
Excellent. Thank you, Jenny and Irene. We, just as a reminder, we'll be able to send the slides afterward, and we'll also have a recording of this presentation for anyone who wasn't able to join. Thank you all so much. Have a great day.